Welcome to our Back to School, Back to Basics My Wealth webinar on how to generate more income utilizing covered calls. My name is Jeff Hunter and I'm a senior associate and associate portfolio manager with the Townshend, Somani and Hunter Group at Canaccord Genuity. Also on the line are our senior investment advisors, Dave Townshend and Raheem Somani. For more information about our team, our process, and our exclusive My Wealth Global portfolios, please check out mywealthmanager.ca. Today's call is with Cliff Cassidy and James Learmonth of Harvest Portfolios. Harvest focus on building covered call solutions through ETFs and are an integral part of our My Wealth income portfolios. Today's call will be recorded, so be sure to check your email in the coming days for access to the replay webinar. With that, I'll pass it off to Cliff. Cliff, can you tell us a little bit about yourself and Horizon's portfolios?
Yeah, you bet. Thanks, Jeff. And Cliff Cassidy, sales representative at Harvest ETFs. I'm based in Calgary and I cover Alberta, Saskatchewan. Yeah, that's me, pretty simple. And James, are you able to pull up the presentation? We'll just hop right into it. I'll run through a couple of intro slides and then I'll pass it over to you. You know, and I think can't really tell how many people are on the on the Zoom call today, but if you have any questions as we're going through it, just fire away and we can keep it pretty informal and we can answer them. So yeah, anyway, here's the presentation. I guess James, you're in control, so I'll tell you when to switch the slides. But yeah, once again, the focus will be on covered calls, and James is one of our senior portfolio managers, and so he's responsible for the options on a couple of the ETFs. And yeah, so we'll keep it simple for you. That's the what we're going to be focusing in on today: covered calls and how our strategy is effective at Harvest. And yeah, just before we hop into that, just a bit about Harvest and a little bit more on what James will talk about today. That's Harvest. Those are all the important people at Harvest. So that's who we are. And yeah, why is it up there? I mean, pictures are always important. You can get to know people through that, and then just a bit more about us. But also, we've had huge growth in the last 3 years, and so if you can see here with this slide, you know, we put the structure in place for that growth that we've had over the last year. So so that was helpful to manage all that, and then we're built for more growth going forward with the same structure that we have, adding people as we best see fit to, but also as well as that you know, there's clear lines for each division that you see here. So you know, there's no conflict of interest is the other point here that we want to make about Harvest. So you're in good hands, and I guess we can move on to the next slide, James. Yeah, so here's the investment team. James is up there. You can see his picture as well. And over 60 years managing money, so lots of experience on the team. Obviously, that's a good thing. And then what's unique about Harvest is that everyone's responsible for a specific sector rather than a geographic area. We feel this adds more value. So they're a sector specialist, and then they're also responsible for all the options that they trade on each of their mandates. So that's another value added point. We'll move on to the next slide, James, thanks. And so at Harvest, there's really two platforms. There's equity income, equity growth. We'll spend most of the time on the equity income side today and what we do, not really talking too much about product, but so the equity income is the covered call platform, and the equity growth is thematic growth. If you had questions on that, you know, we can answer those too, but we'll be spending pretty much all of the time on the equity income platform. So we'll go to the next slide, James. So last slide, and then I'll pass it over to James. So, you know, thanks very much to Jeff and Dave and Raheem. They've been a big part of our success over the last 3+ years. And so the company's been around since 2009 and got into ETFs about 6 years ago, very successful. So we're about 2.5 billion now, just about. And there's actually 15 ETFs currently trading on the TSX. So lots of choices for you. Huge growth. Thanks so much for it. You guys have been a big part of it. And yeah, I think with that, I'll pass it over to James, and he can, talk about covered calls, our strategy, and why they're excellent choices all the time, but definitely in the current market, they can really add a lot of value. So pass it over to James. Thank you.
Thanks, Cliff. So I will go through kind of basically what covered call writing is in general. I'm going to talk a little bit about our approach to covered call writing and our active covered call strategy. I will start off relatively basic, so I apologize if anybody is a little more familiar with options already, but just to kind of build up in complexity, we'll sort of layer on concepts as we go through. We do have some literature on our website, www.harvestportfolios.com, if you are interested in reading some more. That will cover a lot of the stuff that we're talking about today, and have a few additional things here and there. So let me just start off by talking about what is a call option. Well, a call option is basically a contract between a buyer and a seller for where the buyer has the right but not the obligation to buy an underlying stock at a pre-specified price that we call a strike price. And in order to get that right, they pay what we call a premium to the seller of the call option. The call option seller, also known as a call option writer, receives that premium from the buyer, but that person, that writer, is then obligated to sell the underlying stock at that pre-specified price if the buyer chooses to exercise their call option. So what's a covered call option then? Well, a covered call option is a total position where you buy the underlying stock ahead of time, and then you sell or write a call option on that stock. In this kind of situation, you actually have the stock in your portfolio. So if you do get assigned, as we call it, by the call option buyer, you then already have the stock in your portfolio to deliver to that buyer. And that's in contrast to what you would call a naked call option, where you don't already own the stock. And so the seller would have to go into the market and buy the underlying stock at the market price, and then sell it to the call option buyer at presumably a lower price or the strike price. So why do we use call option writing strategy? Well, the first point is that it enhances the yield of the total portfolio by generating those premiums from selling the call options. That's over and above the underlying dividend yield of the actual holdings. I'm going to put an asterisk on this next point. So it does create tax advantaged monthly cash flows from the premium generated. In our funds, and in most cases, the premiums that are generated from selling call options are taxed as capital gains. But I would urge you, if this is something you are doing particularly on your own, to seek a tax professional, because there are some circumstances where those premiums can be taxed as income, but in most cases it's capital gains. It can also reduce the fund's volatility, and I'm going to walk through an example of this in a few minutes. But those premiums can help to offset any of the declines that you might see in the stocks during a given period, in exchange for forgoing potentially some of the upside on an equity rally. And then adding to that point, it can add to total returns in challenging market environments. Again, you're receiving that premium that you get to keep as a call option writer, which kind of offsets or can offset any declines in the underlying equity position. So just kind of building up how it looks to enter into a call option position, a covered call position. So this is looking at the payoff or the profit if you were to just buy a stock all by itself. If you buy a stock at $100, if the stock goes to $101, you have a $1 profit. If it drops to $99, you have a $1 loss. Pretty straightforward. In a covered call strategy, in this example, if you are writing against your entire equity position, if you buy that stock at $100 and then you sell a call option that has a strike price of $100, so you become obligated to sell the stock at $100, you receive, in this example, a premium of $3. If the stock goes down to $99, you lose $1 on the stock, but you get to keep that $3. So your total profit that we can see here by the dashed red line is still $2. And so in this kind of position, your total position remains profitable all the way until a $3 loss on the stock. And then after that, then you start to lose on the overall position. But the option premium gives you kind of that buffer for any stock declines. The flip side of that is if the stock appreciates in value, you'll be obligated to sell the stock at $100 regardless of where the stock goes. And so that $3 premium that you received for writing the option is the maximum profit that you would actually be able to realize on this position. And then taking it a step further, and I'll go through our process in a little bit more detail in a second. But at Harvest, we cap our write level so that we can't write against any more than 33% of any individual position in our portfolio. And so what that means is you don't generate as much premium on the entire portfolio, but you're also still exposed at a minimum to 67% of any market move on a stock market advance. So if the stock goes up, you can still participate on 67% of that roughly. So I'm just going to very quickly look at our equity income process. I'm not going to spend a lot of time on this, obviously, with the call being focused on call options. But this is kind of the process that we go through for most of our equity income products that Cliff was talking about earlier. So we start by defining a broad universe, usually based on a long-term secular theme or sector. Then we use some basic quantitative metrics to narrow that universe down to a small manageable number of stocks. And then we select 20 stocks for our portfolio that we equally weight across the portfolio and rebalance it on a quarterly basis, such that every time we do this rebalance, those 20 stocks have to be superior to that narrow universe on several metrics. For example, in our healthcare fund, it has to have a higher average dividend yield, a lower average PE ratio, and a higher average return on equity. And then in our equity income products, we overlay our active covered call option process. So as I mentioned, the only restriction that we put on our covered call writing process, our covered call strategy, is that we cannot write on any more than 33% of any individual position. And so I say any more because it leaves us the flexibility to write on up to 33%. So on some stocks, if we see an opportunity for a short-term rally, or if option premiums are not necessarily as high as we might otherwise see them, we might not write anything at all, or we might vary somewhere between that 0 and 33% write level. But we give ourselves the flexibility to use different strike prices on the underlying stocks. We can step in or step up our write levels up to that 33% write level over time. And really, the objective is to maximize the gains on the portfolio while still earning our distribution. And so I won't go into a lot of detail on our process, but suffice to say, for our equity income products, we pay a fixed monthly distribution. And so the very first step for us every month is to calculate how much option premium we actually need to generate from the sale of calls in order to meet those distribution requirements. And then from there, we go through a multi-step process that starts at a very high sector and market level and works its way down into individual stock level analysis and option analysis in order to decide what contracts we write, how much we write, and when we write. And then from there, we monitor our positions on a daily basis, looking for opportunities to buy back positions that we're able to realize most of the profits, or perhaps increase positions where we think there's an opportunity to add to our option writing position. And then finally, at the end of the month, we go through a more detailed analysis process that's really just trying to help us improve our process as we go forward. And so this is where it's going to start to get a little bit complicated. So I hope I don't lose anybody here. But one of the major inputs into that kind of demonstrates how much of an option premium you get is what we call volatility or implied volatility in the market. So the amount of volatility that investors are expecting in a given stock. So this is just looking at the S&P 500 implied volatility. And really, I just want to show here that since COVID, we've seen kind of a step change up in levels of volatility in the market. So generally speaking, we've seen option premiums increase over the past few years. And I'm going to show you what that looks like for our strategy and how we can actually monetize this increase in volatility that we've experienced or we are experiencing in the markets. So this is just, it's a little bit complex under the surface, but this is calculating a calculation of a theoretical option premium on a theoretical stock using the average implied volatility level that we saw for sort of the 8 years prior to COVID. So this is using a formula that's called the Black-Scholes option pricing model, and it's kind of an industry standard for evaluating the price of an option. And so with that average volatility level that we saw prior to COVID, we could generate on a theoretical option 1.7% premium. So $1.70 on a $100 stock, for example. Using the average volatility that we've seen since in the post-COVID world, that estimated premium jumps up to $2.50 or 2.5% on a $100 stock. And so you can see that even though markets have become much more volatile, the amount of premium that you can, and cash flow that you can generate from a covered call strategy has increased pretty significantly. And then just as of last week, the current right levels again are even higher than we've seen in the average in the past 2 years. And so in the current environment on this theoretical option, you could generate about 3.4% on a $100 stock. And so this is just, I'm not going to go in depth on the products. I'll leave that for Jeff to have a discussion on suitability for you and your portfolios. But this is just a quick snapshot of our 6 largest equity income portfolios. Again, all using our active covered call strategy to enhance the underlying dividend yield of the underlying holdings. So that's all I have for a formal presentation. Jeff, I'll pass it back to you. And if you've got any questions or want to open up to Q&A, be happy.
Yeah, I think one of the first thing is, especially over the last few years, we heard about GameStop and those types of stocks and the amount of calls that were purchased in there and the amount of money made off of those strategies in that time. Can you highlight just the actual amount that are winning when you purchase a call or put versus how many that are assigned versus how many that expire worthless, and why this is a great advantage for a writer who's protected with a collateral behind it?
Yeah, so it does vary given different markets. In the current market, we're unfortunately in a pretty sustained bear market this year, and so we are seeing very few times actually that we're getting assigned. I would say probably, just a ballpark off the top of my head, maybe 85% of the time we're getting called away, or at least have our options in the money at expiry. So the market price of the stock is higher than the strike price. In a bull market like we saw in the previous 2 years, it was more often that was happening. I'd say it was probably, depending on the month, probably something more like 15 to 20% were out of the money, with the majority of them in the money at expiry. So it does vary quite a bit depending on market movements. Really, in this type of environment, from the covered call strategy perspective, is because of that increased volatility, you can generate more premium. And so even though we pay fixed distributions, that gives us the ability to write less in these types of times where we see, for example, markets maybe or individual stocks may be particularly oversold on a short-term basis and primed for a rally. we don't have to write as much because we're still able to generate that extra premium from the higher volatility and participate more in any bounce that we see in the stock.
So just time frame's a large one. Can you talk about the benefits of writing short dated ones and rolling them over versus long term,
Sure.
and the additional benefits of shorter time periods?
Absolutely. So I guess to start off, let me just try not to go down a rabbit hole. But when you look at an option premium, you can basically break it down into two components. You have what we call the intrinsic value, which is the difference between the market price of the stock and the strike price with a lower bound of 0. So if the market price of the stock is less than the strike price, then the intrinsic value of the option is 0. If the market value of the stock is $1 higher than the strike price, the intrinsic value is $1. The other component is what we call time value. And that is basically the difference between the price of the option that you see less that intrinsic value. So the reason we typically use 1 month options as opposed to longer dated options. And the reason for that is even though on a dollar basis, you would see a higher premium for those longer dated options, as a call option writer, our best friend is what we call time decay. So that drop in that time value component as we get closer and closer to expiry. And one of the points about options and their time value is that what we call time decay, the greatest amount of time decay happens between kind of 1 month and expiry, in that last month of the option's life. And so by writing that 1 month option, we're able to take advantage of that much more rapid time decay than if we were to write a longer dated option. And that allows us to kind of roll those options forward and generate a higher premium over time.
Is there a typical max time frame or a strike date that you will write?
For us, typically 3 months would be the most. Normally, if we go beyond a month, it's only 2 months. And that's generally just if we see a particular event that we want to make sure we capture. Could be an analyst day, an earnings event. In the case of our healthcare fund, it might be a drug trial with sort of, if we're expecting results for a drug trial, but the timing is a little bit uncertain, we might write a 2 month option just to make sure that we capture that volatility that we see from that event taking place in the time frame. But it's most of the time, I would say 98%, 99% of the time, we're writing 1 month options.
And then just another one here. Also, is there a typical premium strike price to current price or a minimum premium?
We don't have a formal minimum premium, and it depends on fund, just because not all stocks are uniform in the amount of premiums that you can generate. For example, technology stocks, on average, I would say typically have higher premiums just because the technology sector tends to be more volatile. So I would say in most cases, we don't like to write anything if we can't generate a premium at least 50 to 75 basis points in a month. And sorry, I forgot the second part to that question.
I think it was just the typical typical premium strike price to current price.
Sure. So generally, we are about at the money, which is writing the strike price at the current market price, to about 3% out of the money. Again, it does vary by fund. Technology stocks in particular offer opportunities to go further out of the money when we write and still generate pretty significant premiums. Lower beta stocks, like for example, a utility stock, doesn't necessarily have that opportunity very often to write further out and still generate a premium that's sufficient enough to meet our distribution requirements. So, but on average, usually about 0 to 3% out of the money.
And one thing, especially with Harvest, what are the benefits of doing them through an ETF versus on your own or structuring them yourself?
I would say a big part of it is along the same lines of owning any ETF as opposed to doing it yourself. You kind of, for one, you're able to put it into the hands of a professional to monitor on a daily basis. because it is a lot of work to keep monitoring these positions and be aware of what you've got written and what's happening in the market. And we're able to kind of consolidate all of that into one portfolio and make it a little bit easier for people to manage that exposure.
Just quickly, Raheem, do you have anything?
Yeah, you know, if you look at it from the more macro perspective or the backdrop of the market, what's most friendly for you as a PM? Is it highly volatile, a market that has the VIX accelerating, you know, volatility, creating opportunity, or, you know, maybe different perspective? Is it a sideways market where you guys are able to capitalize on basically, you know, premiums and adjusting those into the portfolio? So, you know, when should investors get excited about harvest the most?
I think this kind of environment that we've seen all year is particularly good for covered call strategies in general, including ours at harvest, of course. Because of that higher implied volatility, you are able to generate those cash flows, particularly if you're an investor who's looking to generate cash flow from your portfolio. A covered call strategy gives you that opportunity to generate cash flow, but at the same time stay exposed to the equity markets for whenever we bounce or whenever we hit the bottom and turn back into a bull market again.
That's a good answer. And then secondly, on the taxation part, and maybe not you, or if maybe this is for Cliff, you know, non-registered portfolios, you know, can you explain the distribution model to investors, especially for a tax positioning?
Yeah, definitely. I mean, you know, I could send it over to you after this. You know, on an annual basis, we give a breakdown of, you know, how all the distributions were taxed for that year. Typically with us, and I'd say covered calls in general, you can expect about 75% of the distribution to be taxed as capital gains. And then the rest, if they're invested in companies outside of Canada, then it'll be interest income. So yeah, I would say, you know, you can expect 75% cap gains in the distributions from us, and then the rest would be interest income.
And how do you guys handle Forex? Because obviously, you know, we're working with multiple markets here, but, you know, the opportunity naturally, I would assume, is the US market. How do you guys handle Forex? Are you completely hedged? Just give us some thoughts on that.
Sure. So absolutely, most of our portfolios are fully or heavily exposed to the US market. And so for most of our portfolios, we have 3 options available. So this is in particular for our healthcare fund, our brand leaders fund, and our tech achievers fund. We have 3 classes. So a class A that is priced in Canadian dollars and fully currency hedged at all times. We have a class B that is not currency hedged, but priced in Canadian dollars. So you do have that exposure to the currency if you are looking for that. And then we have a class U, which is priced in US dollars and doesn't have a currency hedge. So because it's priced in US dollars and the holdings are in US dollars, the performance of the class U roughly approximates the performance of the class A. It just gives you that option to buy and sell in US dollars, as well as collect your distribution in US dollars. And then some of the other funds, not all of the funds have those 3 classes necessarily, but the rest do all have a class A that is fully currency hedged and priced in Canadian dollars at a minimum.
That's awesome. Jeff?
I think one of the things that I like, you guys being a Canadian company, especially with some of our ultra high net worth individuals, owning US stocks, you know, the names that we love, the ones that are found in the brand leaders, and doing this exposes you to additional potential taxes with the IRS if your valuation's high enough. What you can do with this is own it through a Canadian corporation, and benefit from that. And that's correct, and they haven't changed anything under that, correct? So
Yeah, well, yeah, basically, yeah, that's the advantage of using an ETF versus doing it, you know, owning the individual securities, U.S. stocks, because you know, our most ETFs are considered Canadian trusts, which ours are. So you avoid any kind of taxation that you know, from a U.S. standpoint. So yeah, in a nutshell, brand leaders, it's mostly U.S. companies. We take care of all the taxation issues behind the scenes, so the end investor doesn't have to.
Perfect. I think if there's anything else, Raheem?
No, I'm good. That's a very thorough overview. It's simplistic in nature, difficult to put into process unless you have the time. And as James, as you alluded to, you have all of the capacity in-house to do it by yourself. So it's nice to see that you guys have grown, because obviously time frame and the years and the experience of doing it is fundamental in terms of our diligence process for our clients. And it's quite impressive, the yields that you guys are garnering and the steadiness that it provides the underlying portfolio. So you guys are doing a very good job, and we hope to see the success continue. Jeff?
Yeah, thanks everyone. Any more questions?
Just don't want here. Does option liquidity drive equity holdings?
It does to an extent. Most of our covered call mandates do require that that any positions that we take do have liquid options underneath. Yeah, that's about it. It's definitely a requirement that the holdings for most of our products are some of our global funds. We do have a global REIT and a global utilities fund that have, as the name implies, have holdings outside of North America, where we do write some over-the-counter options. But most of our portfolios, yes, do require that there are liquid options available for any of the holdings that we take positions in.
Well, perfect, James. I really appreciate your time. Cliff, always a pleasure. Everyone who joined us today, and then the ones on the replay, thanks again for sharing your lunch hour with us, and we'll be chatting soon.
Yeah, I hope it helped everyone. If you have any more questions, just fire away.
Have a great afternoon.
Yeah, thanks.